Joining us now to talk markets, Eric Freedman, Chief Investment Officer of U.S. Bank Asset Management, which has $480 billion in assets under management. It's good to see you. Eric, do you feel good about the continuing uptrend in the stock market? Because no one felt good 2 years ago or a year ago when it was really a good time to feel good. Now everybody's on board at 22 times earnings. Are there enough positive things going on to make you want to stay here?
Yeah, Joe, we do think this is a weighing exercise, to be sure, but we do think that the positives outweigh the negatives. I think there's a couple things to really focus on. Number one, valuation, which is never really a catalyst, is not our friend. To your point, 22 times this year. Next year expectations at 15% earnings growth is a little bit lofty. We have to see if the consumer will hang in there. We think that they will, but probably there's a bit of a pullback in estimates for next year. I think the other variable to really pay attention to, and it's important to talk about it now, is what's happening with guidance from companies. We still think the bias from CFOs will be in tech spending, specifically cloud, away from enterprise software, away from enterprise applications, but also think that the consumer, in terms of just that bifurcation across the upper income consumer versus lower income consumer, that's probably the biggest variable to see if this economy still works and if, again, corporate earnings will come in at those lofty levels expected for next year. So
there'll be no expansion, multiple expansion, but we don't need it. The earnings will take care of whatever advance we get.
Yeah, the swing factor on multiple expansion, Joe, will be that delta between where the Fed is for next year at year-end Fed funds versus where the market is. The market thinks the Fed is going to cut by 50 basis points more than the Fed said 2 weeks ago. If the market's right, the Fed's wrong, which we actually think is probably the more likely case. We think the consumer on the lower income side will actually slow down more. You can see, let's call it a point in change of multiple expansion. But again, that would require Fed funds coming down to something looking more like a 3.5 or a 4. That to us is really the swing factor. So again, I think that there will not be, as we like to say, a normally distributed set of earnings coming out for the next couple of quarters. You know, tech, what certainly was the darling for the last couple of years, has been more under pressure on the chip side, but we still think that, again, no better cure for high prices than high prices. And certainly if you look at labor trends, which we'll get a great update on tomorrow, CFOs are really spending much more on capital than they are on people. So that we think is still a decent tailwind for tech investors as we push forward into the new year.
There are people that say the secular bull that we're in right now isn't even that old. Do you agree with that? A lot of money on the sidelines, too, that if we need more fuel to keep the market going?
Yeah, I think 2022, Joe, was that year when nothing worked, if you look at across both stocks and bonds. And then we also saw at the same time a real ramp higher in rates. What we've seen from a significant change in investor psychology is the focus on income. And investors got away with really high money market rates. So they saw 5.25% returns on their cash. I think that's been a conditioning factor that has really changed, if you will, in terms of market psychology. In other words, people tend to look now more at their income in their portfolios than their total return, which we think is not the right approach. But the beneficiaries, we think, will likely be areas of the marketplace that do capture some yield and some income. Everything from some of the dividend-paying stocks that haven't worked, but also things like business development corporations, master limited partnerships, structured credit, some of the more esoteric parts of the market that we'll see clients replace cash holdings with areas like those that again do provide some good current yield and draw more cash out of the sidelines.